When Trump put a 90-day pause of tariff on most of the countries except China, you all believed his words that he is incentivizing those nations who came to the negotiating table, whereas he's sort of punishing China for their continued economic aggression and lack of respect for global markets. However, the real reason why Trump put out a 90-day pause is to save his own country's economy from crumbling. You see, he did not lay out this pause even when the US stock markets crashed. S&P 500 index fell almost 12% within 5 days, from 5,670 points on April 2nd to 4,835 points on April 7th. Trump was still not very bothered, but on April 8th, something happened, and then on April 9th, the tariffs imposed had to be withdrawn. Let us understand this in a very simple language and also what happened in the real world. Hello everyone and welcome to the Fintelligent Investor channel. I am CA Pratiksha Pai. If you are new to the channel, please subscribe to our channel to get complex finance news and topics broken down into simple tidbits for you. If you feel that my talking speed is slow, you can watch on a faster speed. The relevant timestamps are also given. So let's dive in. Well, from April 2nd to April 8th, when the stock markets in the US were plunging, parallelly, on the other hand, the US bond yields were rising. On April 2nd, that is the day that reciprocal tariffs were announced, the stock market saw a sell-off and the 10-year US Treasury bond yield stood at 4.17%. Eventually, on April 4th, the yield fell to 3.96%, but then it again started to rise in the following week and touched 4.34% at the end of April 9th, which became the single most factor for Trump to announce the 90-day pause immediately. In order to understand what happened, first we should understand some basics. Laying the basics straight. First and foremost, a yield on a bond is the interest on that bond. Interest, yield, more or less same thing. However, interest is on the face value, but yield is tied to the market value. So yield goes up and down. Now when bond prices fall, the bond yields rise, and when the bond prices rise, the bond yield falls. Now you may ask, how is this? How can a yield rise if the price of the bond falls? So let me quickly explain. Understand this. US bonds are also called US Treasury bonds or Treasury securities. So don't get confused when these terms are used interchangeably. It's the same. See, if I purchase a US Treasury bond for say $50, okay, and the interest is 10%. So what is the interest that I earn? 10% of 50, that is $5. Now, say the bond prices fall and I sell it for $40. Now, for the person who has purchased, he has purchased for $40, but he's earning $5 yield, the same amount as before. Now, if you divide 5 by 40, it works out to be 12.5%. So when the bond price was $50, yield rate was 10%. And when the bond price fell to $40, the yield rate went up to 12.5%. I hope you understood. So this is why when the bond yields are increasing, it means that there is a sell-off happening in the bond market and the prices of the bond are crashing. This is exactly what rang the alarm bells for Trump, that the bond yields rose from 3.96% to 4.34%, and that indicated that there is a sharp sell-off in the bond market and that the bond prices are crashing. From this, we understand that there is an inverse relation between the demand and bond yield. When the demand decreases, yield increases. This much you understood? If yes, please let me know in the comments if you are clear till here. What happened on April 8th? Coming to the next point, the yield was increasing, which in other words meant the bond prices were falling because the demand for bonds was decreasing. This meant that there were no buyers in the bond market. Now on April 8th, when US government auctioned $58 billion worth of 3-year bonds, there weren't enough buyers, point number one. And the US banks were obliged to buy up any supply that was not purchased by the markets. And the banks ended up purchasing around 20.7% of this offering. This rang the alarm bells in the US administration. See, what are bonds? Basically, the government or corporates are borrowing money from investors by issuing bonds, and they are paying you interest. Why are bonds important? Any government, while spending on various aspects in an economy like defense, infrastructure, social security, or in our own country for various incentives, agriculture, and all that, government does not spend only from the tax that it has collected. The government also borrows from the market by issuing bonds and utilizes this money for various purposes. And a strong economy like US is a very strong world leader economy. The stronger the economy, the more are the number of buyers, or I can say, whenever these bonds like US bonds are auctioned by the government, they are never short of buyers, and especially so in the case of US. Now, why did I say especially in the case of US? Why are US bonds never short of buyers? See, US Treasury bonds are never short of buyers because every country needs US dollars for international trade. Like in Indian context, we need dollars not just to buy goods from US but also for our trades with various other countries. So, when US government auctions bonds, investors as well as other countries purchase these bonds to accumulate US dollars for their purposes. And this is why US bonds, at least, are never short of buyers. Unlike our neighbor Pakistan, whose bonds are actually junk bonds, but that's not our topic of discussion for today. Anyways, different countries hold US bonds as a part of their forex reserves. India holds around $225 billion, China holds almost $760 billion, but the country that has the largest holding of US Treasury securities in the world is Japan. They hold around $1.08 trillion worth of US Treasury bonds. Now, what happened on April 8th, Tuesday, as I already mentioned, when the US government auctioned $58 billion worth of bonds, there weren't enough buyers. And the US banks were obliged to buy up any supply that was not absorbed by the investors of up to 20.7% of the total offering. And this started stressing the banks. Why weren't there enough buyers and why did the existing bond investors sell? We should understand why the bond auction flopped and on the other hand, even sell-offs happened. On April 2nd, when the tariff announcement came, the bond prices actually rose and the yield fell, which is a good thing. The yield fell from 4.2% on April 1st to 3.8% on April 7th. This was an expected reaction because when the stock markets fall, the investors sell their shareholdings and move their money to bonds, which are generally more safer assets than shares. While this was the case, why did the sudden sell-off happen on April 8th? Now, experts say that this happened due to something called basis trade. Large hedge funds own assets across stocks and commodities, but that is purely on leverage on borrowed funds, wherein these shares and other assets are the collateral. This means the large hedge funds have invested in these bonds, but it is on borrowed money. Like, say you took a loan by pledging your shares. You get a line of credit depending upon the market rates. And you invested this borrowed money in other shares. Okay. Now, the price of the pledged shares start to fall. So, your overdraft facilities extent also starts to fall. Because, say, for a 100 rupee share, if you got an overdraft facility of 90 rupees, which you utilized, but now that share price itself is 70 rupees from 100 rupees, then the banks call you and tell you to pay up the some 25 rupees, which is like 90 minus 70 minus some overdraft margin, so that your overdraft is within the limits of the market price. In the same way, these hedge funds also had invested on borrowed money. And here, see, it is much more complicated, okay, than the simple example that I gave. These investments involve cash and future positions and hold leveraged positions, but let's not get into the complicated parts. Net, when the markets fell, experts suggest that these funds got the margin calls to top up their collateral. and so they sold hugely on the bond market, which led to the huge sell-off in the bond market. Another theory that came up to support the lack of buyers was that countries like China may have abstained from buying US bonds in a kind of a revenge tactic against the USA. Also, it is possible that otherwise big buyers, especially Japan, may have not only abstained from buying but sold some of their holdings as well. So, when more selling has happened, the prices have fallen and the yield has increased. Conclusion: as a ripple effect, when the government bond yield increases, the corporate bond yields increase even more since they are a few basis points above the government bonds. It was noted that the corporate bond market also had no buyers. If the bond prices suddenly crash, then this puts banks and insurance companies under a lot of pressure because these institutions may not be able to make their payments due to liquidity shortage. So, the immediate effect of a sharp fall in bond prices can lead to a lot of tricky situations in the economy, even going as far as bank crashes and much more. And this was the juncture where it is believed that the United States Secretary of the Treasury, Scott Bessent, and other experts and corporate leaders really prevailed on Trump to get in this pause of 90 days to again stabilize the markets, majorly the treasury markets. So yes, this was a quick video on the actual reason behind the 90-day pause granted to most nations and how very intertangled stock markets and bond markets are. I hope this video was educative and useful to you. Please like the video if you felt that the content in the video was useful and helpful, as well as share it with your friends and family to spread the financial literacy. We will continue to come up with more such educative videos in personal finance. Till then, stay subscribed, stay connected. Thank you.